You ever look at your tax return and feel this strange mix of resentment and resignation? Like you're doing something fundamentally required, paying your fair share, being a responsible citizen, while somewhere in the back of your mind, you know the math doesn't quite add up. You're handing over 20, 30, maybe 40% of what you earn, and then you read that someone worth $8 billion paid less in taxes last year than you did, not less as a percentage, less in actual dollars. And your first reaction isn't anger, it's confusion. How is that possible? What loophole are they exploiting? What offshore account? What shady accountant? What illegal scheme makes that work? But here's what's going to bother you more than anything else, I tell you today. It's not illegal. It's not even particularly complicated. In fact, the strategy that allows the wealthiest people in this country to functionally opt out of the tax system has been operating in plain sight for over 100 years. It's so straightforward that a law professor managed to explain the entire thing in 3 words. Buy, borrow, die. My name's Anderson, and I've spent years trying to understand not just how wealth is built, but how it's preserved across generations while everyone else is watching their paychecks get demolished by withholding. And what I found isn't what I expected. The wealthy aren't smarter about taxes. They're not hiring better accountants or finding more creative loopholes. They're playing an entirely different game, one with different rules, different objectives, and different scorekeeping. And once you understand how this game works, you'll never look at wealth, taxes, or financial fairness the same way again. Here's what most people believe about taxes. They think everyone operates under the same system. You make money, you pay taxes on that money, and what's left over is yours to save or spend. The percentages might vary based on income level, but the fundamental structure is universal. Rich people just have more money going through the same system. Right? Wrong. The entire premise is backwards, because here's the contrarian truth that changes everything. The tax system isn't designed around wealth. It's designed around income. And if you understand that distinction, really understand it, you can see exactly how the wealthy have managed to accumulate trillions of dollars while contributing almost nothing to the system that supposedly taxes them. Most people earn income. They work, they get paid, and the government takes its cut before the money even hits their bank account. There's no negotiation, no strategy, no way to defer or avoid or restructure. You earn, you get taxed, you live on what's left. But wealthy people don't earn income, not in the traditional sense. They own assets, and assets are treated completely differently by the tax code. When you own something that increases in value, stocks, real estate, art, private companies, that growth isn't taxed. Not while you own it, not while it's appreciating. The government can't touch those gains until you sell, and if you never sell, you never pay. This is the invisible threshold that separates how wealthy people think about money from how everyone else does. It's not about making more. It's about owning things that grow in value without triggering taxable events. Think about what this means psychologically. Most people are trapped in a system where every dollar they earn immediately becomes partially the government's. They feel that loss constantly. Every paycheck is a reminder that they're operating under someone else's rules, giving up a percentage before they ever see the money. But when your wealth comes from asset appreciation, you don't feel that loss. Your net worth climbs, your portfolio grows, your holdings increase in value, and none of it generates a tax bill until you choose to make it taxable. You're operating with complete control over when and how much tax you pay, if you pay any at all. So let me show you exactly how this works, because the mechanics are simpler than you'd think and more consequential than most people realize. Phase 1 is buying assets. Not for income, not for dividends or interest or rental payments that generate immediate taxable cash flow. You're buying purely for appreciation, for value that accumulates quietly in the background without the government getting involved. This requires a fundamental psychological shift from how most people approach money. Regular people think, I need this asset to produce cash flow so I can live. Wealthy people think, I need this asset to grow in value while I find other ways to access cash. Let's use realistic numbers. Say you have $2 million to invest. You could put that money into dividend-paying stocks that generate maybe 80,000 annually in income. That 80,000 gets taxed immediately. At federal rates plus state taxes, you're losing maybe 25,000 to taxes right away. You're living on 55,000 and your principal stays at 2 million. Or you put that same 2 million into growth assets. No dividends, no distributions, just pure appreciation. Over time, at historical market returns of roughly 8%, your 2 million becomes 2,160,000 the first year, then 2,330,000, then 2,516,000. In 10 years, that 2 million becomes roughly 4,300,000. You've generated 2,300,000 in gains, and the tax bill on those gains, zero, because you haven't sold anything. The government can't tax appreciation that hasn't been realized. But here's where most people get stuck. How do you live? How do you pay for anything if all your money is locked up in assets you never sell? This is where phase 2 comes in, and it's the part that most people never knew was possible. You borrow against your assets, not like taking out a home equity loan to cover emergencies, not like borrowing on your credit card because you're stretched thin. This is strategic borrowing that transforms your unrealized gains into spendable cash without creating a taxable event. Here's how it works. Banks and financial institutions offer something called securities-based lending. You pledge your investment portfolio as collateral, and they extend you a line of credit based on the value of those holdings. Typically, they'll lend you 60 to 80% of your portfolio's value, depending on what you own and how much you're worth. So with that $4 million portfolio, you can borrow roughly $2,800,000. That money shows up in your account, and here's the beautiful part from a tax perspective. Borrowed money isn't income. The IRS doesn't tax it. You can spend it on anything: houses, cars, living expenses, investments and other opportunities, and none of it appears on your tax return as taxable income. Let's say the interest rate on this loan is 5% annually. You're paying about $140,000 per year to access $2,800,000 in cash. Meanwhile, your underlying portfolio is still growing at 8% annually, generating roughly $320,000 in returns each year. You're paying $140,000 in interest, but your assets are growing by $320,000. You're net positive $180,000 annually while living off borrowed money that generates zero tax liability. Think about what this does psychologically. You're living a lifestyle that would normally require substantial taxable income. Maybe you're spending $300,000 a year, but on paper, your income is zero. You're not earning anything, you're borrowing, and borrowing isn't income. Meanwhile, someone earning $300,000 in salary is getting destroyed by taxes: federal, state, payroll, Medicare. They're paying maybe $90,000 to $100,000 in taxes annually. You're paying zero. Same lifestyle, completely different tax reality, not because you're breaking rules, because you're playing a different game. Now, I know what you're thinking. This has to catch up eventually, right? You can't just keep borrowing indefinitely. At some point, those loans come due, someone has to pay them back, and when you sell assets to repay the debt, won't you get hit with massive capital gains taxes? This is where phase 3 comes in, and it's the part that reveals just how fundamentally tilted the system is. You die. I'm not being morbid, I'm being accurate. The entire strategy culminates in death because that's when the tax code offers its most generous gift to wealthy families: stepped-up basis. Here's how this works, and pay attention because this is the mechanism that allows dynastic wealth to compound across generations without ever being taxed. When you die, your heirs don't inherit your assets at the price you paid for them. They inherit them at their current market value. All the appreciation that happened during your lifetime, all those gains that you carefully avoided realizing, simply disappears for tax purposes. Let's go back to our example. You bought assets worth 2 million. They grew to 8 million over your lifetime. You borrowed against them and lived well, but you never sold anything, so you never paid capital gains taxes. When you die, your heirs inherit those assets valued at 8 million, not 2 million. 8 million. If they sell immediately, they owe zero capital gains taxes. Zero. Because as far as the IRS is concerned, the assets were acquired at 8 million and sold at 8 million. No gain means no tax. Your heirs take a portion of that 8 million, pay off your outstanding loans, and keep the rest. Let's say you had 4 million in debt accumulated over the years. They sell 5 million of the inherited assets, pay off the 4 million in loans, and pocket 1 million all tax-free. The remaining 3 million stays invested, ready to repeat the cycle for the next generation. You started with 2 million, you lived off borrowed money for decades, you paid virtually no taxes, and your family ends up with 3 million plus whatever you spent during your lifetime. The government collected nothing. Now, let me show you what this looks like at scale, because the numbers become almost absurd when you apply this strategy with real wealth. Imagine someone who built a company and now owns shares worth 50 million. They could sell those shares, pay capital gains taxes of roughly 10 million, and live off the remaining 40 million. That's what most people think wealthy people do. But why would they? Why trigger a $10 million tax bill when they could borrow 35 million against their 50 million in holdings, pay maybe 1.75 million annually in interest, and never create a taxable event? Their 50 million portfolio grows to 60 million, then 75 million, then 100 million over time. Their borrowing capacity increases with it. They refinance periodically, taking out larger loans at better rates as their wealth compounds. When they die, their heirs inherit assets worth 150 million at stepped-up basis. They sell enough to pay off outstanding debts, let's say 50 million in accumulated loans over a lifetime, and keep 100 million tax-free. Starting capital, 50 million, ending wealth, 100 million, taxes paid, essentially zero, all perfectly legal, all using strategies that have existed for over a century. The system isn't broken. It's working exactly as designed. It's just designed for a different class of people than the ones who think taxes are something everyone pays equally. And here's where the psychology gets really interesting, because understanding this strategy changes something fundamental in how you see wealth and fairness. Most people operate from a mindset of contribution. They pay their taxes because that's what citizens do. They accept that some portion of what they earn belongs to the collective system. They might complain about how those taxes are spent, but they don't question the fundamental obligation to pay. But the wealthy don't operate from contribution mindset. They operate from preservation mindset. The goal isn't to contribute fairly. The goal is to protect and compound capital across generations. Taxes are friction, something to be minimized or eliminated entirely through legal structure rather than illegal evasion. This isn't a moral judgment, it's an observation about how different financial classes think about the same system. When you're earning income, taxes feel inevitable. When you're growing assets, taxes feel optional, something that only happens if you make the mistake of selling. This creates two completely parallel financial realities operating in the same country under supposedly the same tax code. One reality where people earn money and lose 30 to 40% before they ever see it. Another reality where people grow wealth indefinitely and pay nothing until they choose to, if they choose to at all. Now let's talk about why this matters beyond just feeling unfair, because the implications ripple through the entire economy in ways most people never connect. When the wealthiest people in society aren't paying taxes, someone else has to make up the difference. Government spending doesn't decrease just because billionaires figured out how to pay nothing. The burden shifts to wage earners, to small business owners, to anyone whose wealth comes from income rather than asset appreciation. This creates what economists call regressive pressure. The people least able to afford taxes end up carrying proportionally more of the load than people with vastly more resources. A teacher making $60,000 pays a higher effective tax rate than someone with a net worth of $600 million, not because of tax brackets, but because of structural differences in how their wealth is categorized. And here's the really insidious part. This system becomes self-reinforcing. Wealthy families use buy, borrow, die to compound their wealth across generations without tax erosion. Each generation starts with more capital than the last. More capital means more borrowing capacity. More borrowing capacity means more ability to live lavishly without income. More asset appreciation means more wealth to pass tax-free to the next generation. Meanwhile, families building wealth through earned income face taxation at every step. Their accumulation is slower. Their compounding is interrupted by tax events. Their ability to pass wealth to the next generation is limited by estate considerations that don't apply when assets receive stepped-up basis. Over time, this creates widening wealth inequality that has nothing to do with work ethic, intelligence, or value creation. It's purely structural. The system mathematically favors inherited wealth over earned wealth. Let me show you one more angle on this that most people miss. How this strategy changes investment behavior in ways that affect everyone, even people who will never use buy, borrow, die themselves. When wealthy investors know they never plan to sell their assets, it changes what they buy and how long they hold it. They're not looking for quick gains or trading opportunities. They're looking for assets that will appreciate steadily over decades without generating taxable distributions. This creates sustained buying pressure on certain asset classes, primarily stocks of large, stable companies that don't pay dividends, real estate in appreciating markets, alternative investments that grow in value without cash flow, and that buying pressure drives prices higher, which means everyone else investing in those same assets is paying more for them. You're competing with buyers who have infinite holding periods and who never need to sell, even if prices get absurd. That changes market dynamics in ways that are almost impossible to quantify, but definitely affect valuations. Additionally, because wealthy individuals can borrow against their assets instead of selling them, there's less supply available in the market. Assets get locked up in portfolios that function essentially as permanent collateral. This artificial scarcity pushes prices even higher, benefiting existing holders while making it more expensive for new investors to enter. The wealthy aren't just avoiding taxes on their own gains, they're potentially inflating the value of everyone's holdings through behavioral patterns that only make sense if you never plan to realize gains. Here's what makes this especially frustrating. The political conversation around tax fairness completely misses the point. Politicians debate raising or lowering capital gains rates. They argue about whether the top bracket should be 37% or 42%. They propose wealth taxes or minimum income taxes for billionaires, and none of it matters. Because you can't tax income that doesn't exist. You can't collect capital gains on assets that never get sold. You can't create a wealth tax that captures unrealized appreciation when people can simply borrow against their holdings indefinitely. The buy, borrow, die strategy renders almost all proposed tax reforms irrelevant. You could raise capital gains taxes to 90% tomorrow, and it wouldn't affect someone using this approach at all. They're not realizing gains, so the rate is meaningless. You could implement a minimum tax on people earning over a certain amount, and it wouldn't matter. They're not earning income. They're living off borrowed money. The entire debate is theater. It makes voters feel like someone is trying to address fairness, while the actual mechanism of wealth preservation continues untouched and unexamined. So, what does this mean for you? For someone who doesn't have millions in assets to pledge as collateral or access to securities-based lending at favorable rates, honestly, probably nothing changes immediately. This isn't a strategy you can implement with a 5-figure net worth. The minimum entry point for securities-based lending is typically around $500,000 in liquid assets, and it doesn't become really efficient until you're working with several million. But understanding how the system works changes something important. It changes your strategy for building wealth in the first place. If you know that the goal isn't just to accumulate money, but to accumulate assets that appreciate without generating taxable income, you make different choices. You prioritize growth over income. You think in decades rather than years. You structure things from the beginning with an eye toward eventual tax efficiency rather than immediate cash flow. You start thinking like someone who plans to use this strategy eventually, even if you can't use it yet. And that shift in thinking, that long-term, asset-focused, tax-aware mindset is what actually separates people who build lasting wealth from people who just earn good incomes and wonder where it all went. Here's the thing that nobody wants to say out loud. This system isn't going to change, not meaningfully, not in ways that would actually close the gap. Because the people who benefit most from buy, borrow, die are the same people who fund political campaigns, who hire armies of lobbyists, who have the resources to shape tax policy in their favor. They're not going to voluntarily give up a strategy that allows them to pay virtually nothing while compounding wealth across generations. And the rest of us? We're too busy working, earning taxable income, and paying our fair share to organize effective opposition to something most people don't even know exists. So the system persists. Wealth compounds tax-free at the top, while wage earners shoulder the burden of funding government operations. And every few years, politicians propose marginal changes that sound significant, but don't touch the fundamental structure that makes buy, borrow, die possible. It's not a conspiracy, it's just math and incentives working exactly as you'd expect them to work. The people with the most to gain from the current system have the most power to protect it, and they do. So here's where we end up. You now understand something that most people go their entire lives without realizing. The tax system isn't one set of rules applied fairly to everyone. It's two separate systems operating in the same space. One for people whose wealth comes from work, another for people whose wealth comes from ownership. You can't change that system. You didn't design it. You don't control it, but you can understand it. And understanding changes what you build toward. Maybe you'll never have enough wealth to borrow millions against your portfolio. Maybe you'll spend your entire career earning income and paying taxes like everyone else. But maybe, just maybe, you'll structure things differently now. You'll think about assets instead of just income. You'll consider appreciation instead of just cash flow. You'll build toward a version of wealth that isn't entirely at the mercy of tax policy designed for wage earners. That's not nothing. That's actually the beginning of thinking like someone who might eventually have options that regular income earners don't. And 20 years from now, when you're looking back on the decisions you made after learning how buy, borrow, die actually works, you might be grateful. Not because you became a billionaire who pays nothing in taxes, but because you stopped thinking about wealth the way poor people do and started thinking about it the way people who actually build it do. The system's not fair. It never was. But understanding how it actually works is the first step toward navigating it effectively, instead of just being crushed by it. And that's worth knowing, even if it makes you angry. Especially if it makes you angry.